Welcome to the first section of the Fundamentals of Investing course, and in this video we are going to talk about the financial system. Now, one thing to keep in mind before we begin is that the purpose of this section is to introduce some general concepts. Understanding the purpose of the financial system and some terminologies like equity and debt securities, bonds, mutual funds, financial assets, and some general concepts. But since this is a course for beginners, we won't get into the details that much, so I don't confuse you. And if by the end of the section you still feel like you didn't quite get some of it yet, it's okay, because we will talk about them again later in different sections of the course, and I'll promise it will make more sense to you. All right, so obviously, when it comes to investing, we all know it takes money to make money. And for majority of us, the money comes from our savings. I think we all know that, if we spend less than we earn, we have savings. And if you want to earn a return on your savings, you are investing. So it all starts with savings. And combined with the fact that if you leave your money the way it is, in cash, it's going to reduce in value because of inflation, which is the reduction in your purchasing power. And even if it didn't, let's say super low inflation or something, there are opportunities to make your savings grow through investing. Now, to understand the importance of savings and how you, as a saver, can become an investor, first we need to understand the financial system. So let's start with a problem, then we'll see if the financial system can solve it or not. Let's say you have a business idea, but you don't have enough money to set it up. So what do? Maybe you start asking your family, your friends, for money, and you continue until you find someone who has saved up enough money and is willing to lend you the money. Also, obviously, because they believe they can get back more than they lend. Everybody's happy. Now, the problem is that this whole process has taken a long time, and there might be some, trust issues or legal issues along the way. I mean, what if he or she doesn't pay you back or something, right? So we can see the need for a system that connects those who need money, we call them, users or spenders of capital, with those who have savings and are willing to invest. We call them savers or providers of capital. Well, that system exists, and it's called the financial system. A financial system is a system that allows the exchange of funds between lenders, investors, and borrowers. And within the financial system, there are industries that offer a range of products and services to savers and spenders and help channel the funds between them. Now, the main components of a financial system are financial intermediaries, such as banks and insurance companies, and financial markets, like the stock exchange, which we will get to in a minute. But first, who are these savers and spenders? Now, in our example, you with the business idea were the spender, and the person who was helping you out was the saver/investor. But if you're anything like me, you'll be leaning toward the investor side than the guy with the business idea. Anyway, savers include individuals, companies, and governments that have money to invest. And spenders also include individuals, companies, and governments. I mean, for example, you as an individual borrow to pay for your house and other expenses, or to set up that business idea. Now, companies borrow to invest in land, buildings, and machinery. Governments borrow when the taxes they collect is not sufficient to cover their spending plan. Okay, great. Let's talk more about investing. So you have your savings and you want to start investing. What can you do? I mean, what are your options? So investments in general can have three types: ownership, lending, and cash. Meaning you can use your money to own stuff, or you can lend it to someone, or you can keep it, in cash or cash equivalents. I will explain what I mean by cash equivalents soon. So, number one, you can use your savings to own items that grow in value over time, also called assets. Assets are items that are purchased with the expectation that they will produce income or profit. Remember, anything that declines in value with its use, it's not an investment, it's an expense. I hope I don't confuse you. For example, in most cases, your car is not an investment. But if you work with your car, like, taxi, since it's generating some income, it's an investment. Now, I think it's a good place to explain assets a bit more. So assets include real assets and financial assets. Real assets, we all know, which are physical assets, such as land, buildings, machinery, and gold. Financial assets are a bit tricky. Financial assets are claims on assets. For example, a share of a stock represents ownership in a company. Now, this share gives its owner, who is also called a shareholder, a claim to some of the company's assets and earnings. So if you own Apple share, let's say, you have a claim to some of the company's assets and earnings. You are part owner of the company. I mean, in most cases, a very, very, very tiny bit, but still. Anyway, we will go back to the financial asset later, but let's continue with the investment types. So number one, you can use it to own assets. Number two, you could lend your savings, say, to the government using bonds. What's a bond? A bond is a fixed income instrument that represents a loan made by an investor, you, to a borrower, in this case, government. We could also have corporate bonds. Now, bonds are a whole topic on its own, and fixed income in general, which we will talk about later. But for now, it's enough to know that bonds are like loans, but tradable loans. So, back to the lending your savings. Now, even your regular savings account, you, the investor, is essentially lending money to the bank. And the bank will pay you interest. Number three, cash. Now, when I say cash, I mean you have the option to leave your money the way it is, in cash, which means you are investing in cash, in that currency, but just that currency. Or you can use cash equivalents. Now, these are investments as good as cash, which means that they can be converted back to cash easily and quickly. For example, money market funds, which are similar to saving accounts and can be purchased at any bank. But the difference is that the investor commits to leaving the money alone for a period of time in return for a slightly higher rate of interest. And the time period for cash equivalents is as little as 3 months and no longer than a year. So, the general investment types: ownership, lending, and cash. All right. Let's go back to assets, particularly financial assets that are claims on assets, remember? Now, if you are a company that need money to, let's say, grow or expand, your options to get that money is either to bring in new owners by issuing shares or to borrow. Now, in general, in terms of borrowing, when a company or government agencies decides to take out a loan, it has two options. The first option is to get financing from a bank. The other option is to issue debt to investors in the capital market. And sometimes debt issuing method of raising capital may be preferred because a bank loan can, restrict how the funds can be used. Now, if those shares and debts are tradable, meaning transferable, the investor can easily transfer it to another investor, they become equity and debt securities. Now, financial assets that can be traded are called securities. And the two largest categories of securities are debt and equity securities. And trading securitized instruments are simpler and easier because the debt, for example, is already split into handy denominations. Anyway, now when you hear the word security, you know what it means. All right, so let's talk more about debt security. And keep in mind that we have a section dedicated to debt and especially equity. And like I said, this is just to understand the terminology and the overall concept. A debt security is a type of financial asset that is created when one party lends money to another. And of course, lenders expect the borrowers to repay these loans and make interest payments. And because interest payments on many loans are fixed, debt securities are also called fixed income securities. They're also known as bonds. For example, government bonds are debt securities issued by governments. And investors lend money to the government in return for interest payments, also called coupon payments, and also return of their principal. Now, when an investor buys a corporate bond, they're essentially loaning the corporation money and also have the right to be repaid the interest and principal once the bond matures. Now, what do we mean by maturity? It means the loan's duration. A bond's term to maturity is the period during which its owner will receive interest payments on the investment. When the bond reaches maturity, the owner is repaid its par or face value, which is the amount that they promised to pay. So when you say bond matures in 5 years, that means the duration of the bond, the loan, is 5 years. So you should get the face value. And the maturity date is set when the bond is issued. And anyway, no need to worry about bonds right now, because like I said, we will discuss it later. Now let me give you a different example. Let's say you purchased a home using a mortgage from your bank. From your perspective, the mortgage represents a liability. A liability is something a person or a company owes, usually a sum of money. So the mortgage represents a liability. You must make regular interest and principal payments, right? And from the perspective of the bank, however, your mortgage loan is an asset, a debt security that entitles them to a stream of, interest and principal payments.